Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Mike Ingram, who is a strategist at BGC Partners, who's kindly made his way along to Core Finance, Core Castle as the Moose will call it, for a Friday. How are you today, Mike? You are?
I'm good, always good. Friday afternoon. Been a good week, but looking forward to the weekend.
Indeed. And well, it's been a busy week with the Bank of England. You've kind of brought along a couple of slides, a few talking points. Dovish positioning hosed.
Yeah, so, I mean, they call it Super Thursday, don't they? And most of the time it hasn't been very super. It's been super boring, I suppose, is what you'd say. And it was only a month or so ago that I was in this very studio talking to you, I think, where I was showing you this slide saying Bank of England fails to convince, because what happened in the August Monetary Policy Committee meeting, MPC meeting, they said, well, we think the market's got it wrong on interest rates. We should be looking at a steeper yield curve. And the market gave a collective yawn, said, we've been here before many, many times, and flattened the yield curve even further. This time around, I mean, there was no surprise that QE's on hold, no surprise that it was a 7-2 vote. What was surprised was the very hawkish statement that came out from the Bank of England, where they said that over the coming months, and there's clearly a lot of wriggle room as what that means. They saw that a majority of the MPC saw a case for raising rates if the economy continued, on its current course, if growth held up, if the so-called slack in the economy continued to erode. And as I said, the market had been positioned very complacently, perhaps, arguably, and they weren't prepared for that. That's why you saw this huge move on markets. So this is the overnight interest basis swap. To determine where the market thinks interest rates are going. And this is for the December meeting this year for the Bank of England. So we went from about a 1 in 4 chance of a rate hike in December, or by December, shall I say, to at the moment 64% this morning. And yeah, so that big, you can just about see that big flip. Squeezed at the end of that. Perhaps I should have given a bit more room at the end. But I mean, that's the highest expectation of a rate hike that we've seen this side of the referendum. Now, of course, when the referendum took place, rates were already 0.5%. They're 0.25% now. So not quite apples with apples. And a one rate hike is now fully priced in by February of next year. And by the way, we saw the knock-on effect on sterling. Clearly, that's continued through this morning. And what's also helped it earlier on this morning is a speech given by perhaps the most dovish member on the MPC, Gutjan Vlieger.
Very dovish.
And very, very Dutch. And I hope I did that pronunciation some level of justice.
Yep.
Well, did we for ABN years ago? He said, look, he's basically with them. He can see a rate hike, or maybe even 2 rate hikes. So great. It's nice to be able to change your mind like that. But anyway, so it seems to me that they're all on message. And they're all very, very determined for that move that we've seen in interest rate expectations, certainly at the short end, for that to stick, because they were clearly very uncomfortable back in August with what the market was pricing in. The market, as I said, didn't listen to them. So they're leaning into it very, very heavily now. Now, what's also interesting is the justification for this. Now, part of it's, I think, simply down to market psychology. We know that, we know the history to the Bank of England's so-called forward guidance. They've, frankly cried wolf many, many times, particularly over the last 3 years, kicking off, I think, with that now infamous Mansion House speech from Mark Carney in June 2014. And in fact, one of the previous MPC members, Andrew sent, I think, an acerbic tweet saying, well, why should the market believe you? Look at what you've done.
And he's still very vocal, isn't he, Mr. Sentence?
He's active on Twitter. Yeah. He's active on Twitter. He's not the only one, it has to be said. But, it's quite nice for him to see him batting that straight back. But they were talking about growth holding up. They were talking about signs of wage growth. And you're thinking, well, really, what data have we had in since the last MPC meeting? And you go, well, wages, well, they were slightly better than expected, but they were still below what the Bank of England was itself expecting. It's running at 2% rate. Inflation was somewhat higher, 2.9%, but that takes us back to where we were back in June. So nothing particularly that really moved the dial. They're sort of choosing it to be glass
half full. I mean, wait for the next data to come out, and maybe a blip? Have they, the Bank of England, are they moving too soon on this? Are they going to end up again with egg on their face when macro doesn't perform?
Well, there's certainly the potential for that, isn't there? Because they've lifted the market, as they would say on the trading floor. They've lifted the market, and there is expectation they'll deliver. Now, of course, let's say at the end of the year they look at it and the Brexit negotiations are doing badly. You know, it looks as though it's not going well. Although I think Juncker said that he didn't see a hard Brexit. Although what does he think hard Brexit looks like? But you know, you could have it. It's very easy to put a scenario where it's not looking great. So you know, you've got very difficult Brexit negotiations. You're seeing consumer confidence starting to go down. Businesses starting to retrench. Employment gains slow, and then maybe even flip to higher unemployment. You know, the UK consumer, which is the driving force behind these GDP numbers, these growth numbers, are very reliant on the consumer. We haven't seen any evidence really of any rebalancing of the economy on the back of weaker sterling. Nor would you expect that, quite frankly, on this sort of timescale. That's a multi-year issue. So it's quite possible they've given themselves a room, because what does the coming months mean? It's all conditioned on forecasts coming in more or less as they expect. And I would add that they've already cut their growth forecast twice this year. I think another cut is very likely. And it's also interesting in this vein to bring in what the rest of the market or rest of the economists are thinking, so people outside of Threadneedle Street. And although their forecasts for this year, economic forecasts for this year, have held steady at about 1.5%, still below the Bank of England, they go from 1.7%, they've trimmed their forecast for 2018 back still further. They're only going for 1.2% growth next year out of the UK economy. So it does look as though we're at an inflection point. As I said, if the data doesn't come in, I think the Bank of England has yet again lost more credibility. But they kind of double down on it now. I mean, because this is a big move. This is a huge move.
Huge move.
The only other point I want to make, and I put another chart together on this.
Let's have a look at that. Don't panic.
Is again putting this in context. So. Again, this is a slightly different measure. The previous one was a measure of interest rate expectations from overnight index swaps. This is from sterling, 90-day sterling futures. December 2017, I say, in the blue, December 2018 in the red, and the green's 2019. And I've converted it in such a way that it delivers what the interest rate is going to be at those dates, or what it thinks it's going to be. So basically speaking, as I say, they're thinking a very high probability of an interest rate increase around the turn of the year. 0.5% to 0.5%. Then following year, maybe another interest rate hike over the course of, by then, 2018. I've got to double check that. 2018, and then maybe another rate hike, or a high probability of a rate hike during the course of 2019. So this is not in any sense a prelude to what we might consider a traditional rate hike cycle. I don't actually know where you've seen a traditional rate hike cycle post-financial crisis. Certainly, you know, we've kind of not seen it from the Fed, which is further ahead than any other central bank, certainly major central bank, you know, because they've been talking about 2-3 rate hikes for many, many years, and, you know, delivered one in 2015, delivered one in 2016, delivered 2 so far in 2017, and market thinking maybe a coin flip for that third rate hike. So they're the closest to it, but we kind of feel as though we are where the Fed was in 2014-15. And of course, one of the things that the Fed didn't have to contend with was, as I say, Brexit, which is a huge swing factor, you know, given the importance of consumer confidence, business confidence, and, as I say, just keeping that whole bandwagon. But as I say, it feels a bit more dramatic than it actually was, because I say positioning was so concentrated, so complacent at the short end. But you have to put that in the context of where we might be, say, 2.5 years up the road. In that respect, you'd have to say, well, you know, in terms of that green line, we're pretty much baked back to where we were at the start of the year. At which time, by the way, the Bank of England was sounding quite dovish, even though they had very punchy economic forecasts, which of course made no sense. But you know, if you're looking for consistency, don't talk to anybody in Threadneedle Street.
Final note, Mike. When is the interest rate going to happen? Come on, put you on the spot.
Well, I think this year is looking way too early. I think the soonest possible will be February. And the reason why we pick February as opposed to January or December is that even though the MPC will always like to say that every meeting is live, the Fed always says every meeting is live. Some meetings are clearly more live than others, and it's generally assumed that if the Bank of England were going to make a move, it would be synchronised with the release of their quarterly inflation report. And they'll bring one out in November, and then after that, the next one will be Feb. Having said that, I think the growth numbers are going to come in weaker. I think the wage growth is going to come in weaker. Again, this is highly conditional on how the Brexit negotiations go, but I think that business investment is likely to be weaker. So all other things, I think growth and inflation will be lower. And, I think it was always a big ask from where we were a few months ago, where people were saying we won't see an interest rate rise until the end of Brexit negotiations, until March 2019. You were going, that looks nuts.
That's too far.
Yeah. I always assume that we'll see it at some point in 2018, and that view doesn't really change in my view. And if I were, and again, this is, finger in the air kind of exercise, I suspect on the basis that those numbers are going to be weaker, I suspect it's probably going to be mid-2018 as opposed to some point over the next 3 to 6 months.
Fantastic. We look forward to that. But we'll obviously...
I'm on a fixed rate mortgage, so it makes no difference to me.
But we'll certainly have you back in before then. Mike Ingram, BGC Partners, thanks very much for joining us today.
Pleasure, Matt, as always.